Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And today we're exploring a strategy known as the wheel strategy, which is very income-oriented. It's a combination of selling puts and covered calls. Should be an interesting discussion. We'll talk about how it might be done, when a trader might choose to implement this sort of a strategy. A lot to cover, but before we can get to that wheel strategy, very first thing that I want to do is say hello to everybody that's joining me out there on YouTube. Hello out there, Eva and David. And I want to scroll around here and see who else is here. We have Lawrence, hello, VJ, Andrew, everybody else. Thanks for joining us week after week. Mighty Mouse, everybody else. Great to have you here. We always appreciate your attendance and your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Monday webcast series. It kicks off promptly at 2 Eastern Time. We'd love to have you in the live stream audience. And also, as a special treat for my live stream audience, my very good friend Scott Thompson is going to be joining us here in the chats. Scott's going to be addressing questions that I can't get to just during the flow of the presentation. Scott and I have now worked together for just about exactly 20 years, so he knows a lot. It's good to have him having my back. I'd also like to issue an invitation to everyone, whether you're watching a live stream or you're watching on the archive. If you're not following me on X, please do that. You can find me there on X at Cameron May CS. It's the best place to connect with me in between the live streams. But let's get into this discussion of the wheel strategy. And as we do, of course, we need to set the stage with a quick review of the risks associated with trading. This is important information, so bear this in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set an agenda for what we're going to be discussing over our 45 minutes together. First of all, we do have existing positions in our example paper money portfolio, so I need to go have a quick look at those, see if there are any that need attention. I think there's one that we might need to do something with today. Then I'm going to take a short overview of what's going on with the S&P 500. Rough run for the last 2 or so weeks for traders out there. But then we're going to be planning and placing a new trade with the purpose, the ultimate intended purpose, of setting in motion the wheel strategy, which is actually a combination of first selling puts and then, if assigned, selling covered calls on new stock positions. And then it's lather, rinse, repeat from there. We're going to talk about the pros and the cons of that strategy and make sure that we also place an example trade before we're done today. So let's go right to the Thinkorswim desktop trading software platform. And here are our 4 positions in our covered calls and short puts discussion. First of all, we have AbbVie. And by the way, yeah, it's been a rough go for the last 2-3 weeks for stock investors generally. However, for our portfolio, it's actually not doing too poorly. So with AbbVie, just to remind ourselves, we bought some shares of stock on the 3rd of February and then sold a covered call position against that on the 24th of February. So bought for $190.71. Right now, the shares are trading up there at $218. That's well above our 210 call strike. So we are up here in an elevated risk of early assignment. Now, risk is always sort of in the eye of the beholder as far as the participants of the trade are concerned. We bought these shares down here at $190.71. For the next little while here, through the 21st of March, someone has the right to buy those shares from us for $210. If they did, would that be a disaster? No, we'd actually make $19.29 on the stock shares. Plus, we collected a $224 premium. That leaves us with about $21.53 per share as a maximum theoretical gain on this trade that we could make. But in any case, we're all the way up here in our profit territory. Now, our break even is down here. If the stock were to collapse if it fell down below the price that we paid for the shares, plus an additional 224 for what we sold the calls for, that would take us to our break-even point of 188.47. That's going to be down here. Now, let me show you something here. I promised somebody, there was a comment in the YouTube chat. Somebody says, how do you make the boxes, Cameron? I said, hey, I'll do that again today, just so we can see. It's really just one of our drawing tools down here. It's the rectangle tool. So let me delete the one that I have here as an example. Right click. Let's just remove that drawing. And if I want that back, I'd just go to where I want to position it. Click to start drawing. Just drag up to where I want to end the drawing and click again. It's actually not a drag. Sorry. It's a click and then move, not a drag, and then click again to set that. Now, if the colors aren't exactly what we want, we can just right click, edit the properties, and choose a color from the palette here. Colors are always up to the trader. Mine is basically a light green and then a pink for the red ones. That's it. So that's how those are drawn. If you want to draw those at home, it's just a visual reference point. Really, if I were doing this trading just on my own, I wouldn't even bother to put them there. It's more to help the learning for those that are watching. But this trade is doing well. And as a matter of fact, it has just about capped itself out. This is the one that I want to discuss. What should we do with this? You can see right now we're up about almost $2,000. Now, if we purchase the stock for $190.71 and someone has the right to buy those shares from us for $210, that means that most that we can theoretically make on the stock in capital appreciation is $19.29. We add to that the $224 that we collected for the premium, and that gets us to a maximum of $21.53 per share, or $2,153 that can be made on this trade. So we're about 150 bucks short of that right now. So some traders might look at this and say, well, we haven't made all the money that we can, but we've made like 90% of it. So maybe it's time to get out of this trade. There are a number of different ways that a trader might consider managing this position at this point. First of all, could do nothing. There's still another $150 on the table. That's a highly likely probability of that we're going to ultimately realize an additional $150 if we just do nothing. However, right now it looks like we could also choose to just cash out and realize the gains of around 2,000 bucks. Helen is saying we could also buy the call back, right? Helen, you say sell the call. I know what you meant. You meant exit, right? We sold to get in. We'd have to buy it back to get out. Now, if we did that, what that does is it allows the stock, if the stock continues to rocket upward, we're no longer under an obligation to sell the shares at 210. So it would allow us now, hey, we're already at 218, so it's freeing up basically some cap space in the profit that we already have. And then if it goes higher, we could make even more. Couple of potential issues. There are pros and cons with each of these decisions. If we buy back that call, it's going to cost us, let's assume that we can get out for what it says it's trading for right now, about 10 bucks. That would be a $7.76 loss per share on the contracts. And then if the stock falls, now we're giving away some of the profits we thought we had on the stock, in addition to the loss that we now realized on the call, and this starts to unwind itself, and we're no longer sitting on a $2,000 profit. So that's a possibility. So if it goes up, great. If it starts to fall, not so good. So which is the right decision? Well, they all have pros and cons. I think I'm actually tempted to just take the profits right now. We have a lesson to be learned from another stock that's been in a similar position to this one, and we didn't do anything, and we're paying the price today. So I'm actually going to leave AbbVie alone. Let's go ahead and have a look at some other ones. We have IBM, bought some shares at $249, got into a contract where somebody has the right to buy the shares for $265, and they're trading a little bit below $265 right now, which is actually fairly optimal for that. So if we want to see that on a chart, bought the shares down here, same day sold the calls up here at $265. We sold those up near the previous resistance. And interestingly enough, the stock has rallied up to that resistance and then pulled back. It's now rallied back up to that resistance again, and it looks like we're getting a bit of a, what we call a shooting star candle up there. Maybe prices are sagging back again. So the call is doing what we might hope, moving toward expiration, out of the money. The stock, well, it's above what we paid for it, so that's also good. Our break-even point is down here at 247.02. That's the $2 and what did we collect? $2.03 on that call. So that one looks like that's doing fine as well. We're going to let that one continue to work. Wells Fargo, this one's a different story. Okay, we need to talk about this. This one was doing well until this week, and boy, it continues to drop. So here we put ourselves in the shoes of a trader who theoretically bought shares down here at $70. So I put some shares in the account with a cost basis of $70, and then, or an assumed trade price of $70, if you want to look at it that way. And then as the stock ran up to this previous resistance, we sold a call just above that resistance up here at 80. So if we got assigned on these contracts, all right, we would have bought the shares at 70, sell at 80, great. Well, we got up above that 80 strike and we kind of chopped around there, but over the last couple of weeks, there's been a collapse in that price. We're now trading below our expiration break-even point of 68.28. This is misbehaving. So a trader may need to decide what to do from here. So what might they decide to do? Well, one thing that we could do, and I think what we will do with this, that $80 call with only a handful of days till expiration, and it's now way out of the money, $14 out of the money, probably would cost us pennies to wrap up that part of the trade. But the trader might also consider, do I really want to own the shares even? Maybe we ought to just get rid of this thing entirely. Now, there could be another reason. It's not just what's happening with price that might motivate someone to have stocks in their portfolio. If it's serving the purpose of, maybe it's the representative stock for diversification for, the financial sector, maybe that's why it's in here, and they don't really mind owning it even through the volatility. Oh, maybe they just go sell another covered call or do nothing, just own the stock and see if the stock rallies up again. But in any case, how much is that call trading for right now? We sold it for $1.72. It would cost us maybe in the neighborhood of 7 cents to wrap that up. And I think what we might also do, let's say that we're going to hold on to this position with the obvious risk. If it continues to plummet, as shareholders, we have that downside risk on the trade, even with a covered call. Having a stock fall, if it falls by more than the amount of the premium collected, that premium is only a minor consolation price. Okay, but what if we were to, let's exit this 80 call, and boy, the way this has fallen, we may even sell, let's see if we can get a premium up here out in April, maybe it's 70, maybe it's 72.5 at what we paid for the shares, or maybe above that. Let's go see what those are trading for, just out of curiosity. I'm going to go to 17th of April. And the $70 calls are trading for $2.20. The 72.5 are trading for $1.40-ish, $1.43. All right. How about we roll our position down from 80 to the 72.5 strike? And maybe that's going to be for a credit, paying 7 cents to get out, maybe $1.40-ish to get in, somewhere in the neighborhood of mid $1.35 credit. So I'm going to go to my monitor tab and let's roll this. Let's right click on our call, create a rolling order, and this is going to describe this as a diagonal. That's okay. But the 21st of March is the contract we're buying out of. Let's move this one out to April, 17th of April, and look at maybe selling the 72.5. There we go. Yep, mid 130s for a potential credit. Let's say we're willing to settle for $1.35 on this roll. Oh, sorry, you're asking a question to Scott. I'll let Scott address that. Okay, anyway, let's quickly submit this. Looks like our credit might be a little bit better than $1.35, but I'm going to submit this as a limit order, saying that's just the least what we'd be willing to take on this roll effort. So if you're not familiar with rolling, it just means we're going to get out of one trade and get into another trade. We're going to do it both of those orders on the same order ticket. That's basically it. See if we can get this filled. Obviously, if we're doing multiple trades, it does dial up the number of commissions that we're paying, so that's a consideration. But let's try to sell this. There is a $1.30 of commission to be paid here, but let's send this off and see if we get a fill there. Yep, sold for $1.38. All right, so what we can now do, if you want to see how I put these lines and things on our chart, so we're now out of this one. Let's edit the properties of this one. I'm just going to maybe make this one pink just to illustrate that we're done with that. Let's edit the properties of this trend line. I'm just right-clicking on the ones that I've previously drawn and choosing edit properties. But we're now in a new trade, and we're going to let's put in a line just above today's candle to show where we started this one at 72.5. Close enough. Let's carry it out there. And I'll right-click on that. Let's make that one red. There's our new strike. So you can see we now have an obligation. Should the stock rally, we're getting back up above the price that we paid. If it does rally, someone does have the right to buy those shares from us for 72.5. All right, so we've managed that position. Now finally, we have ExxonMobil. Bought some shares at 106.92. The shares have climbed to 110.81, so the shares are doing great. Someone has the right to buy shares from us for 115. Those contracts are still out of the money. They could be assigned. Even out of the money contracts could be assigned. Not as likely as when they're in the money. But we bought here, sold our short call right there. So we initiated that trade right up here at the 115 strike. You can see that's still some distance above the current price. There's also an apparent resistance between here and there. So we'll see if that's a technical obstacle that prevents this from being assigned. But that trade's actually doing fine. Our break even for the whole trade is down here at 105.72. And we're just going to let that one work. So done with those 4 existing positions. Let's go have a peek at the markets and see how they're treating us. It's been a rough last couple weeks. There it is. We hit a peak here February 19th, and since then it's been pretty much selling on the S&P 500. We've broken through apparent levels of recent support. Where's the next possible level of support? Could that be down here? It looks like we're already through this one. You know, some might have been looking at this, wondering maybe we can hold here. Looks like we've broken through that. I just want us to be realistic about the sorts of markets that we are entering our contracts into. This is actually a very bearish market condition. I would have to say I feel somewhat fortunate. We've been somewhat fortunate with our stock selection for the stocks that we've traded on. But that could change if the markets continue to persist downward. Covered calls and short puts are both perfectly capable of losing money instead of making money, like we've seen on our existing positions. So we've got to be aware of that. So for some technical traders, they may wait to do something like the wheel strategy that we're about to initiate until a little bit later. Helen says 56.50 was a key support. Could have been, right, Helen? We're down about a little bit beyond 8%. From that recent high, so we're not quite in correction territory, at least on the S&P 500. Yeah, some might be waiting for these lows down here. However, others might actually see this as an opportunity to initiate something like the wheel strategy, where stock ownership may be part of the objective of the trade. How many of you are familiar with this wheel strategy that I've referenced a couple of times already? You may have even started trading it on your own and didn't even know that it had a name. But a wheel strategy is where we set off a potential series of events that starts by selling a put. We sell a put, and if the contract is assigned, we're now owners of shares. And as owners of the shares, it provides a second opportunity for income, which is selling calls against that stock position. And if they get called and we sell the shares, and we sell another put, and on that goes. Jerry, so you're not familiar with that? But I would say some of you, yeah, probably thought about this before, just didn't know that it carried like an official title. But yeah, I want to start off our wheel strategy. Maybe we'll see if it turns out to actually, if we get the wheels turning here, because there's one way that this strategy sort of ends before it ever gets started. But I'm going to start with NextEra Energy. Why are we starting with NextEra? Well, a number of reasons why a trader might choose a stock for initiating trades on. With options, liquidity can be high priority. If you have an illiquid stock, it tends to have illiquid options. It causes issues with the pricing. It makes it hard to trade profitably. Yeah, so highly liquid stocks tend to have more liquid options. So that was a consideration in choosing NextEra as our example. Price per share on the stock can also be a consideration. More expensive stocks can carry higher premiums when selling for income, but also larger obligations. Both of those things might play a role in the decision making. Also, maybe our hypothetical trader might just think, well, NextEra is just a great company. And since in this strategy we're going to be using, ownership of the stock may come into play. Maybe they only want to do this on stocks where they wouldn't mind owning shares. Now, another consideration is diversification. If we already have a bunch of energy stocks already in play, energy stocks, energy trades, maybe we wouldn't want to do another energy position. Or maybe the trader is just starting to build out the energy portion of their portfolio. So a number of things that might be considered. But here's NextEra. A final thing might be, well, it's not final, meaning that's the end of any potential list, but for my list, for this example, what's happening with the chart? Helen says, why not look into the tech sector? Because it's already in bear territory. So Helen, these are not bearish strategies that we're implementing. This is a wheel strategy is actually a bullish strategy. It's a combination of two bullish option strategies. In pursuit of income is usually the driver, usually the motivating factor for this strategy. But in any case, since bullishness is a consideration here, a trader might look for something like a stock that's recently broke through, let's say, a price ceiling. And you can see that unlike so many stocks out there, NEE is actually having a pretty good day. Looks like it had a previous price ceiling that had acted formerly as a price floor right around that 72.5 level. We pushed up through that level. So if we're bullish, we could do a number of potential strategies, could do covered calls, could do short puts. Both of those are bullish strategies. But to start off our wheel strategy, we're going to sell a put here. So I'm going to go to the trade tab and let's go to the 17th of April. The 21st of March is coming up. We already have a number of positions where we have contracts that are expiring the 21st of March. So I'm going to move out to next month for this example trade. And let's maybe look, let's scroll up here a little bit. This is kind of position itself down at the bottom. What if we were to sell, let's say, with the support at 72.5, let's maybe sell that 72.5 put. Okay, so this is sort of the first step in initiating a wheel strategy. We're going to sell. Let's make this bold. There we go. The 17th of April, 72.5 put. And that's going to collect some income for this trader. Something between $1.50 and $1.60 as of right now. Now, obviously, that can change. But let's say that the motivation of our trader is to collect income. And they just want to do that right now and on NextEra Energy into the foreseeable future. Well, if we sell this put, specifically, we're collecting $155. And in exchange, someone has the right to sell shares to us at any time between now and the 17th of April for $72.5. Well, if our trader is okay with stock ownership, that may be fine, even if they get assigned. Assignment for a wheel strategy trader is not a scary scenario. Instead, look at down here. If we wind up getting assigned, let's draw in a line here where we sold that 72.5 put. There's our 72.5. Let's carry it out here to expiration. Let's make it red, just indicating sell. Red doesn't mean danger in this case. It just means we sold a put. So through the 18th of April, someone has the right to sell shares to us for 72.5. Now, if we just put that trade on and then we duck our head into a pillow and then we just come up for air on the 19th of April, one of two outcomes will happen. Either we get assigned or we don't get assigned, right? Might happen before expiration, might happen at expiration. We just know that by expiration, it will have been decided. So let's just talk through how a wheel strategy trader thinks about both of these outcomes. Let's suppose, first of all, the stock just stays above our 72.5 strike and we make it to expiration. Someone has the right to sell shares to us for 72.5, but the shares are worth more than 72.5. They're probably not going to sell us those shares. Maybe they get a wild hair and they do it, but they probably won't. So in that case, looking again at this from this would-be wheel strategy trader, you might say, well, okay, I just realized 155 bucks. That's income now in the bank, realized gain. And what might they do then? Let's suppose they're still bullish on Nextera. Maybe they go ahead and sell another put. So that's one possible outcome. Here's another possible outcome. Maybe we get assigned. Let's say the stock goes down. Maybe it goes below 72.5 before expiration. It's in the money, gets assigned early, or it's still below 72.5, gets to expiration. Yeah, Ricebird. With the wheel strategy, it's sort of that lather, rinse, repeat process. Exactly. So in this first scenario, was that a negative outcome? No, that was a profitable outcome. In this second scenario, let's say our stock goes down to 70 bucks. If the stock is worth 70 and someone has the right to sell us shares for 72.5, are they going to do it? Especially if they're at the wire and they have to make a decision. They don't have any more time to wait. It's expiration. We're either going to sell these shares to Cameron for the contractual right of 72.5, or we're not going to. Yeah, they're going to. With very rare exceptions, they assign us the shares and we're required to buy them at 72.5. That would be $2.50 above what they're worth. That would be kind of an ouch. But now we do own shares, plus our $1.55 that we collected on the premium up front. There's no further obligation associated with that. So at that point, we've realized a $1.55 gain on the option. We have no option in play, and we own shares at 72.5. So now that we own the shares at 72.5, what might the trader do if they're still looking for income? Well, as a shareholder, we could possibly then sell a call. So think about this as just a cycle of events. Sell a put to get things moving. If we get assigned, we own the shares. We sell a call to collect another option premium. And then at the end of that, either we get called out and we sell the shares, in which case we might sell another put and start things in motion again. Or if we don't get called out, then we sell another call. But it's just a constant process of selling options for income. So it's known as the wheel strategy. And I think you can see why. Now, there's one other thing that I think for some they might call this the grease in the wheels, in the axle of the wheels. There's a little bonus here that's potentially available. If we get assigned on these puts and we own the shares and we're selling calls, well, as shareholders, we also may be able to collect a dividend. This is a dividend-paying stock. 56 cents as of the last quarter. On an annualized basis, that's going to come out to roughly $2.25, which is what, in the neighborhood of about a 3% dividend. Now, maybe we own it at the time of ex-dividend, maybe we don't. That just depends on how the stars align, whether we're selling a put and we don't own it, or we've been assigned on the put and we own the shares, we've sold a call. But in any case, there is the potential for additional income in the form of a dividend. So the way I've just described this, how many of you are going, oh, wow, this sounds amazing. This is just income, 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 no problem at all. Well, these are bullish strategies. And if the stock really starts to misbehave and we're persistently trying to do something bullish while the stock is persistently bearish, it still has the possibility of losing money for us net. So typically we would want to do this sort of a strategy on stocks that are generally stair-stepping higher. We don't want to be losing more money on our obligations associated with our contracts than we're collecting on the income from the contracts. All right? So that's it. So let's maybe initiate our put trade. Let's go over here to our trade tab. Let's go to our, what do we decide on? The $72.50 put. I'm going to click on the bid price. Looks like that's climbing a little bit. Let's just talk about this for just a moment. If the put premiums are getting richer, what does that mean about the direction of the stock since we started talking? It must be coming down. As stock prices come down, put values rise. So it's kind of moving in the direction of the $72.50 strike. So let's click on this bid price. And at this point, the trader really needs to carefully consider how many shares can they take on the responsibility of potentially owning. One contract is getting into a contract where someone has the right to sell us 100 shares at $72.50 per share. That would be, $7,200 obligation. So just depends on a trader's tolerance for risk. How about for this example, let's do a couple of contracts. Maybe let's do two. There we go. We're going to sell two of these. Let's see what kind of a credit we can get. Maybe what do we say? $1.55. I'm going to put it in as a $1.55 minimum, just so the numbers are sort of aligning with what we were originally discussing. Now, that doesn't mean that our order will fill for a $1.55. It could be more. It just won't be less. It's either this amount or it doesn't fill. Let's go ahead and click confirm and send. I'm going to sell these two contracts of the $72.50 put, looking for $1.55. That would bring in a premium of $310 minimum minus $1.30 commissions. So $308.70 is what we're looking to get from this. There is this big spooky maximum loss amount. That would be, if we were to get into these contracts, someone has the right to sell us shares for $72.50 and then it collapses on down to zero and we have to buy the stock for $72.50. Yeah, that would sting. Now, how likely is it that NextEra Energy goes bankrupt in the next month and a half? It seems pretty unlikely. It's still just inside the realm of possibility. We have to acknowledge that that's a possibility. Greg says, can we buy low delta? Greg, do you mean sell low delta? I'm not, because we are selling. I'm not quite sure, but let me send this order off. Let's see if we can get filled. There we go. So we just sold, we sold at $1.56. So let's go sort of map this out on our chart. If we just got into this trade, we sold this put, the 72.5 strike. Where would our break even be? Just on this initial portion of the wheel strategy. We know that we just got $1.56 collected. So if we're required to buy the shares for 72.5, but they're worth $1.56 less than that, that's our break-even point. So just so you can see this on our calculator, 72.5. I know that a lot of you could just do this in your head. It's 6 cents. It's going to be 6 cents shy of $71 or $70.94. But in any case, $72.50 minus the $1.56 that we just collected is $70.94. That's going to be our break-even point. Let's draw that in. 70, 90, that's close enough. There we go. Carry that out here. So that's our break even. Let's edit that, make that green. So if we finish above that, whether we're assigned or not, that's the break even for this trade. This is sort of the green area up there. Down below is just where we're falling below break even. Now for a wheel strategy trader, that doesn't necessarily mean devastating outcome. Maybe they fall below break even, but at least they got to buy the stock for a lower price than it was available for on day one. Let's edit this. Let's make this one pink. There we go. Click OK, click apply. Yeah, if we, let's say, if we fall down here to $70, we're below break even, but that's actually still a better scenario than had we just purchased the shares outright up here at 75 and change and then watch them fall down to 70. Helen says, don't forget your commission. Exactly, Helen. Yeah, we don't forget your commission. I don't put the commission in the break-even point. I do draw my break-even stuff without considering the commission because it's not on a per-share basis. It's not that we're paying a commission 65 cents per share or $65. It's just 65 cents. All right. So I'm going to leave that off of this, but yeah, commissions could nudge this down just a little bit further. All right. But from here, the trader probably does need to define for themselves, well, what if the thing just goes completely haywire? What would be the scenario where a wheel strategy trader, they've started the wheel turning, when might they decide, I need to get out of this track? I need to be done with this. Well, typically, that would be if the stock really starts to go into a bearish behavior. This is a bullish strategy. As long as it's primarily bullish, traders okay with going up is okay. Going sideways is okay if we're collecting income along the way. But if the stock is collapsing in value and we're insisting on trying to sell into bullish strategies along the way, that's not a recipe for success. All right. So, all right, our trade's in place. We will say, we'll follow this in future weeks, see if the stock rallies, see if it falls back. See, what I'd like to see from this is that we do fall below 72.5. We get assigned those shares at 72.5, and then we can turn the wheel a little bit further. Ashutosh says, is this on a 1-year daily chart? It is. Yeah, you'll see that most of my trade examples, we use a 1-year daily chart. It doesn't mean it's the only chart that a trader can trade from, but most of these strategies, yeah, they'll be demonstrated on a 1-year chart, and they'll typically play out, for better or for worse, within a month and a half or so. Now, some of our longer term strategies, my other webcasts, they can take longer than that, but most of our short puts, covered calls are going to be done within about 45, 50 days, something like that. All right, everybody, but we've actually accomplished what I set out to do today. If this is your initial introduction to the wheel strategy, we'll see if we can keep this thing rolling in a future webcast. It's going to depend on assignment. I will say, in paper money, early assignment is not a thing. Even if this falls down below 72.5, even if it plummets below 72.5, contracts do not get assigned early in paper money. That's one of the distinctions between practice trading and real trading. Nobody's out there assigning fake accounts or assigning fake contracts. So we don't necessarily have to concern ourselves with that, but we will know come April 18th, 19th, if this is going to be continued wheel, or if we just realize the gain on our short put, and maybe we'll sell another short put. William says, so do you have enough funds in the account to buy the stock? That's a good question. So $15,000-ish. Well, it would be right at $15,000 for the 72.5 strike. Yep, we have $115,000 in this account. Okay. Everybody, it is time for me to let you go. I'm gonna do that, but just remember you have a couple of things that if you haven't done these things yet, do yourself a favor. Number one, if you haven't subscribed to our Trader Talks channel on YouTube just yet, do it now. Go down and click on that subscribe button. It doesn't cost anything. It literally only it takes a second. But our YouTube channel is where we host all of our previous webcasts. The vast majority are posted as archives on our playlists. They're organized by webcast series, so you can find all those previous webcasts right there, and there are hundreds of them. Or you can also join the live streams right here. So make sure that you're subscribed to our channel. It's a great resource for education, for learning about these things. Also, make sure that you're following me on X. If you haven't done that already, let me just show you. My handle there on X is @CameronMayCS. Best place to connect with me in between these live streams. It's also where I post things as they arise. Like, I don't know if you noticed, Yields on 10-year Treasury bonds drop below the 3-month Treasury. What does that mean? We have an inverted yield curve. What does that mean? Can be a sign of potential looming recession. So I did a little poll here to see, guys, do you think there's going to be a recession in the next year? Yes or no? So it's interesting to get sort of my followers' input there. But I'd love to have you there as a follower on X at Cameron May CS. Hey, everybody, thank you for all the likes. I can see 150 people watching the live stream right now, and 58 have already clicked the thumbs up. That's definitely appreciated. If you watch one of our webcasts, you found value in it, if you enjoyed it, click that like button. That doesn't cost anything either. But 2 benefits to your instructor. Number one, pardon me. Number one is it's like saying, it's like applaud. That's applause. That's what it feels like to me when I look over there and see a bunch of thumbs up. Means that my efforts are appreciated. Also, it gives my webcast a boost in the YouTube algorithm. So it just lets more people see these webcasts, find these webcasts, so they can learn about things like the wheel strategy. So always appreciated. Click that thumbs up if you like these webcasts. But beyond that, guys, go enjoy the rest of the webcasts. They're coming up. We have a couple more on the docket in the next couple of hours. So go enjoy those. Hey, Scott, thanks for helping out in the chats. That's very much appreciated. Everybody, I will see you in a future webcast. I'll also look for an X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.